Recording in progress.
The June 15th meeting of the Federated Employees Retirement System of San Jose, and we will have a roll call. Trustee Chandra?
Present.
Vice Chair Jennings?
Here.
Trustee Linder?
Present.
Trustee Abbott?
Here.
Trustee Avasti?
Here.
And Trustee, still learning the names of all the new trustees. Trustee Faulkner is not here.
So may I qualify Trustee Jennings for her participation as a trustee pursuant to the Traditional Brown Act?
Please.
Thank you. Trustee Jennings, can you hear me okay?
I can.
Okay, thank you. What location are you teleconferencing from?
855 East Hilton Drive, Boulder Creek, California.
Thank you. And have you posted the agenda at the location where it can be publicly seen?
Yes.
And is the location from where you're teleconferencing open to the public and ADA accessible?
Yes.
And if any member of the public wishes to be heard at your location, can they be heard by us?
Yes.
Thank you. And for the record, to the extent Trustee Faulkner appears at this meeting, he will not be participating as a trustee of the board and rather be a member of the public. Thank you.
Great, thank you. So we are holding this meeting as a hybrid meeting. Those who are attending virtually, please mute yourself unless you are speaking. And if you wish to speak, please raise your hand and staff will alert the chair. And all votes will be roll call votes. There are no orders of the day. There is no need to waive sunshine. And at this point, we will take public comment. Members of the public who may wish to comment on items not included on the agenda, provided that the matter is within the subject matter jurisdiction of the board. Members of the public who wish to provide a comment at this time may do so by, quote, raising your hand, unquote, in the Zoom app, or if joining by telephone, by pressing *9 on your telephone keypad, or if here presently, to raise your hand. When addressing the board, press *6 to unmute. Please state your name for the record prior to providing your comments. All speakers will be limited to 3 minutes. In addition, public comment on items listed on the agenda will be taken at the time the item is addressed. Are there any members of the public wishing to address the board? Anybody online? Okay, hearing none. We'll move to the consent calendar. Is there any items on the consent calendar that board or staff would like to pull or to comment on? If not, do I have a motion to approve the consent calendar?
So moved.
Moved by Trustee Linder. Do we have a second?
Second.
We have a second by Trustee Abbott. Public discussion, and we will have a roll call vote. Trustee Chandra?
Aye.
Vice Chair Jennings?
Aye.
Trustee Abbott?
Aye.
Trustee Avasti?
Aye.
Trustee Linder?
Aye.
And I vote aye as well. The motion passes. We'll move to the next agenda item, and that is closed session. So we will move to closed session, and I think we need to physically move to another room. Okay. Open session.
Yes.
Okay, so I believe we've already approved the consent calendar. And I believe agenda item number 2 is next, death and survivorship. We'll take a moment of silence to remember those who have served the city and who have passed. Thank you. Agenda item number 3, investments. We start with an oral update from our CIO.
All right, thank you, Mr. Chairman. My apologies in advance. We have a somewhat of a longish investment section today, which we normally don't. This is a rarity because not only do we have 331 performance, but we also have the once in 5 year study that Veris does, and they will be presenting this. But before I do that, as always, pro forma performance as of 2 days ago. And guess what? Fiscal year to date, 6.89%.
So 2 days ago?
Yes.
Not even counting yesterday and today?
No, that's right. Of course, we have another 10 trading days to go. Anything can happen in the market. But we are in excess of 6 5/8. But of course, this is all preliminary, unaudited, pro forma information. So that could change. But still, we need, we hope that none of the Fed governors will open their mouth between now and June 30th, and just let the rally continue.
Okay.
I also wanted to introduce to you the newest member of our team. I don't know if he's on video. He is. Harrison Pierce. And Harrison.
Can we put him there?
Yeah, if he is. If he is, he
Yeah,
wants to
he's
just.
there.
Yeah, okay.
He's there.
If
Yeah,
we
I'm
can't
here.
see.
Everyone.
Okay. Hi, we can't see you, but we know you're there. So he's.
I can see him. This video's on.
Okay, we can't see it here. Oh, there it is.
There you go.
Okay.
So he will join us as of June 26th as a junior analyst on the team.
Okay.
And he's just completing his master's in business analytics at San Luis Obispo, Cal Poly, and where he just got a bachelor's last year in finance and economics. So he continued on for a 5th year. And so we are really thrilled to have him join ORS on the 26th.
Great. Well, welcome to our new employee. Just a quick question on the 6.89% fiscal year to date. So that's based on the public markets as of 2 days ago and private markets as of Q4 calendar year.
That's right.
Are we likely to see a rise or fall in the public market valuations in the succeeding 2 quarters?
In the public market or the private?
The private markets.
Yeah, the private market, well, I mean, the public markets are up,
Yeah.
and so there's a lag.
Uh-huh.
And private managers like the fact that public markets are up, so they don't have to write down their portfolios.
Okay, so there's no tendency for them to write down for another quarter before they write up, or, I guess what I'm asking is.
We should ask Casey Boyer when she's on.
Okay,
soon.
I'm just trying to determine, are we likely to close out the year, assuming we cover these last 5 trading sessions?
Yeah,
Are we going to see it at 6.89 or higher, lower, or,
I hope it will be higher than 6 5/8. Let me just put it that
Okay,
way.
that's-
At the office, Prabhu says 7.03, but I'm not sure why he got that number.
okay, well, how you have your private book, I don't know.
Yeah, and by the way, healthcare is up 8.26%.
Wow,
Yeah, so
okay.
there's some cushion there, and
Okay.
there's no private markets in healthcare,
Okay.
so that's
So,
good.
so not only is it we're meeting our discount rate for the year, or likely to, I believe it'll be at least the 3rd year in a row that we are beating it on an actuarial value.
Yeah, but we have 10 days to go. so-
10 days, I
Yeah,
hear
that's
you.
not jinx.
You qualified it
Yes, yes.
fully, CIO Prabhu.
All right, thank you.
Okay.
With that, if there are no questions, I'm going to invite Ms. Casey Boyer.
Hi, everyone. Nice to be here. Can everyone hear me okay?
Yes.
Uh-huh.
Perfect. Okay, let me share my screen. We are going to do our typical we're going to do our typical quarterly report for the private equity partnership that we have with you all, and go over, I'm happy to go over also some of the market dynamics. Just to cover this page, in terms of 2022, overall, the year was kind of down to par, and what I mean by that is there were some quarters that the valuations were down, and some where valuations were about par. So when we're looking at Q4 specifically, currently the net multiple is at 1.81 times. And if you look and compare that to Q3, the Q3 multiple was 1.79. So really a similar valuation to Q3. We have not yet released Q1 numbers, but when we look at our platform overall, and this isn't speaking to your program specifically, but if we look overall at the market and Q1, the Q1 numbers look to be slightly up, and by that I mean 1%, 2%. So again, relatively on par quarter to quarter. I know, as you mentioned, for the year 2022, publics were definitely down. Private equity investments were also down slightly. However, the difference in some comparison when you're looking between public and private, typically private equity are not written up and down to the extent that public markets are. So if a public market goes up significantly, private equity wouldn't go up quite as much. So when you're seeing write-downs in the public market, that happens as well with private equity. There are typically some write-downs, but it's not quite as drastic as the public markets, and it is on more of a lag. So when we're looking forward to Q1, we don't expect a lot of change either. The other highlighting point on this page is, just kind of a reminder, this is currently a $350 million program. We're continuing to commit in a very calculated way. We work very closely with staff on investment pacing and the investments we're putting into the portfolio. Over Q4, there was a net distribution back to the program of about $2.5 million. And that is, again, kind of on par with what we would expect overall moving forward for the program. I'm gonna move to the last page and just give you a little bit of update here in terms of the performance by investment type and the benchmarking of the program. So as I mentioned, Q4 overall was about on par, maybe slightly up. When we look at that in terms of primaries, secondaries, and co-investments, looking at the TVPI, each one of these, again, was up very slightly. So it's nice to see that across the board, each type of investment is generating return. And we've also added here for this quarter the commitments on this page so that you can have an idea of where the capital is in comparison to the returns. This is a very typical allocation for us where we have a larger percentage to primary commitments that give a really good diversification to the underlying portfolio, and then including secondaries and co-investments kind of on an opportunistic basis of what's most the best opportunities that we see at that time. That's mostly market driven. And at the benchmark, you'll see how the overall program is benchmarking based on your net returns. Like I said, for this quarter, a net multiple of 1.81 times with a net IRR of almost 25%. All trending in the right direction. As a reminder, this is including investments that have just been made. So those investments have yet to generate any real return. So this is a continuing to develop program, and we are happy with where it's headed. So with that, I will open it up to any questions that you might have.
Thank you. Are there any questions from fellow trustees?
My only question would be, when would the next quarter information be available? So this is the end of,
End of fiscal year.
yeah, fiscal year.
I'm sorry, end of
calendar
calendar year,
year.
which is mid-fiscal year. So we tend to lack 2 quarters,
Two quarters?
2 quarters?
Yeah,
When would this
so
be
the
updated?
June 30th information will be here, will be presented in August or September. And at that time, we will get the 331 information
Okay.
for
Okay.
private markets. So this,
So our final fiscal year numbers, all in, would not be available until, like,
Dinesh?
November?
We should be able to internally know it by the end of July, although the report would not be presented to the board until September.
September.
Okay.
For the end of fiscal year?
End of fiscal year as of June 30th,
Okay.
Including private markets in that number?
including private markets, because the custodian bank cuts off collecting statements in the middle of July. So 2 weeks after each quarter end, all the statements that come in, they capture those.
Okay.
Can I ask a question?
Sri Chandra, please.
Casey, I had a question. You said TVPI was up in 2022, and I'd like to maybe dive in and understand how that was possible. I felt like all the multiples.
If someone's talking, we can't hear it. I'm just saying.
Can you pull the mic maybe just a little bit
Is that
closer?
better?
Yeah.
Yes,
Okay, great.
thank you.
Casey, can you hear me?
Now I can.
Okay.
Yes, thank you.
Sorry about that. You said TVP, I just want to first make sure I understood. TVPI was up for 2022 across the private equity portfolio?
It was about overall on par, maybe down just a little bit. The way the valuations worked over 2022 was Q1, Q2, Q2 and Q3 were down a little bit. Q1 of 22 was actually up a little bit, and then for Q4 it was basically on par, a little bit up. So overall, I would say 2022 was about par.
And how did that end up, just overall for the year? Most multiple valuations were down, whether it's revenue, EBITDA, net income. So I don't, what would this, how did that transpire, I guess, just from the bottoms up?
Yeah.
Okay, I didn't hear the question perfectly.
I can repeat it, and I'll be more succinct. What drove the net no change over 21, given all of the multiples that are tracked in public and private markets were down in 2022 versus 2021 substantially?
Yeah, I mean, I would say overall, it kind of goes back to what I'm saying, where actually a lot of the GPs that we've been talking to and you know, underlying companies within this portfolio, a lot of the underlying financials have been tracking. And so, you know, when GPs are forming valuations, and I would say especially for Q4, where they're going through a full audit, it has not been a significant reason to write things down. I would also mention that when we look at private equity valuations, what we actually have historically seen is if you look at an exit within private equity, typically that exit is higher than where that GP was currently holding it the prior quarter. So I'm answering your question in a roundabout way because there's so many underlying portfolio companies and so many GPs that are valuing. There definitely were companies where underlying financials were not positive, but I think as a whole, what we have been seeing in our portfolios is not exactly that same sentiment, where there are companies that are doing well. There are certain sectors, industries that are doing well. And so overall, we just have not had a significant write-down. There definitely were write-downs. Venture was written down more significantly than buyout. And so just when you factor in all of those items, that's how the valuations turned out, kind of as from our platform as a whole and as well as in your program.
Well,
It doesn't make sense to me, but
over the next few years, we'll see the DPIs, and then we'll figure out if the TVPIs are accurate or not.
DPIs all. I mean, look, if multiples are going down, then your growth rate has to go up across your portfolio to maintain the valuations, which did not happen across private equity or venture, but there's a lot of leeway that the auditors give these funds, so we should take these numbers with a grain of salt.
Anurag, we can't hear you again. Are you pushing the button?
No, no, I was looking at Prabhu when I was talking to him. Here, I'll get it really close. Anyway, just to sum, I think we need to take those numbers with a grain of salt, but I mean, it is what it is. You invest in private equity for a very long hold period. Auditors give GPs, because I've been a GP and worked with auditors, a lot of leeway. My bottom line is growth rates have to have gone up for the valuations to stay the same, given multiples have gone down considerably. Venture has not been marked down nearly as much as it should have in 2022. So, you know, these are the reported accurate numbers,
That's right.
but there is some reason to question them.
Yep, very fair points.
To be doubtful.
Yeah, all right, well.
As a follow-up, as a procedural issue, for Neuberger Berman, are we simply aggregating the reports of the various managers in reporting the valuations, or does Neuberger Berman then take some judgment over and above that?
We look at all the valuations. We're talking to GPs quarterly. Co-investments, we especially do actually all our own valuations. And so there's also overlap between the co-investments we make that are also investments in primary funds. So we look at everything very closely, and if we have a different view, we change that valuation to our view.
Okay, so this reflects your judgment on top of what was self-reported.
Correct.
And maybe this is a question for Prabhu. So we have a total commitment of $350 million. That's back of the envelope, about 10% of our total portfolio, and yet private equity has a 4% asset allocation. So where am I going wrong in the math here?
Private equity is way more than 4%. Venture has 4%.
Oh, 8%. Okay, still
8%.
8%. Sorry, still
Yeah.
8% to 10%. So that's close enough for government work.
There currently is an overweight because the
We are
plans
overweight.
had a larger allocation back in 2017 through 2019.
Okay, great, thank you.
We can always increase the allocation.
I'm sure you'll
Trustee
be happy to.
Horowitz.
Well,
Yeah, okay, all right.
okay.
Thank you, Casey.
Thank you.
Excuse me.
Appreciate being here.
So I'm going to, for item 2C, is going to be Eric, right? Eric. So before Eric comes on, I did fail to mention in my oral update that Roberta and I had a very, very good visit with the Federated Retiree Employee Association, and Trustee Linder kindly introduced us, and they asked me a lot of tough questions, and just Roberta was just throwing softballs. No, it was a good meeting. They did have it was a very engaging audience, and they had some good questions. With that, I'm going to introduce Eric. So our consultant contact, Laura Wyrick, whom you all know very well, is out today, and so is Jared. And so Eric's taking their place, so please be nice to him. He doesn't have the history of the system and what we've done, but I'm sure he's up to speed, and Laura has coached him well.
We'll try to keep our abuse to a minimum.
Yes, please. Thank you. Over to you, Eric.
And one quick note before Eric presents, I wanted to note a change on the private markets report. So historically, on the reports, we show a peer universe benchmark to compare our returns against a universe of similar strategies for certain vintage years. Historically, we used a service provided by Cambridge. Last year, Cambridge began increasing their prices and restricting usage, so we couldn't use their data in public reports. So both Neuberger Berman and Makita had to seek alternative sources. So Neuberger Berman switched to using Burgess as their data source. Makita has been using Preqin over the last few quarters. Internally, we've been evaluating alternatives, and we've contracted with Burgess recently. And this report will reflect Burgess data as pure benchmarking data. We found that Burgess had a really robust and large data set, a lot of good data scrubbing that they were doing, and good representation. So they have over $10 trillion of private markets data that they capture within their universe.
And as a result of that change, did we find any changes in our benchmark results?
We did, yeah. So there were some that went up, some that went down as a result of that. But overall, I think it seemed like a good comparison.
Okay, great. Thank you for informing us of that.
Thank
And
you,
I'll turn
Dinesh.
to Eric.
Great, thank you. I'll share my screen. Thank you for welcoming me to the team. We were planning to add me slowly over the next couple meetings, but it just happened that both individuals were out this quarter or this meeting, so they just kind of threw me in. So we'll see how this goes. Just really quickly, Laura did tell me to be relatively brief because she knows I can be long-winded. Looking at the overall private market program, I just want to bring your attention to the far right two columns. This is really just the efficacy of the decision to move to private markets. That's looking at the IRR of the different components of your program versus their public market equivalent. And if you look down those two columns, you can see quite substantial value add from the decision to move into private markets. So that's kind of the proof statement of why we're going through this report and why we've invested there. Moving on to private debt, you can see that overall the private debt program has a commitment of $301 million with an aggregate value of $122 about $1 million, which equates to 4.4% of the overall system, which is above the 3% policy weight. You can see that there were no new commitments this quarter, but there are still, if you look at the cash flows, net contributions versus distributions so far. Moving forward to the different vintages and strategies, you can see that since 2017, when the program really became more robust and built out, again, looking at those far two right columns, the IRR versus the peer IRR is quite robust. Pretty much every strategy going down the line versus the peers until you get to Eagle Point in 2020. Eagle Point does have fixed rate loans versus floating rate. And even though these are high yielding loans, the interest rate environment was so dramatic that it did cause underperformance versus its peers. The newer strategies, of course, do not have enough history yet to have meaningful results. Moving on to the real asset program. This one is being ramped up, as you can see in the chart. It had a committed value of $92 million, and total fair value of assets is $61 million for about 2.2% of the overall system versus a 3% target. As you can tell in the green line, it is ramping up relatively quickly from 2017. There is one new commitment of $11 million, which is HIG IS Partners. And then if you look in the cash flows, you can see that there are still net contributions versus distributions so far. Moving forward to vintages and strategies, similar story where if you look at the far right two columns, since 2017, relatively strong results across the board versus the peer group. A little bit less so than private debt, but still quite strong. Looking at real estate, committed value of $280 million with a fair value of $110 million, which equates to just shy of 4% of the overall assets of the system versus 3% for the target weight. There is one new commitment for the quarter for $13 million. That's DRA Master. And if you look at the contributions versus distribution, much more balanced as you would expect from a longer dated portfolio, one with more vintages. Again, looking at the far right columns, if you kind of focus in on 2017 and down, a little bit more mixed results than we've seen in some of the other ones, but overall quite strong performance. Here's the individual strategies. Again, moving down the list, relatively strong. The one I would point out is the IPSO 5, where you do see that negative return versus about 12% return for peers. That's a European-focused fund, and European real estate, given everything that's happened in Europe, has struggled, and then also currency headwinds given the strong dollar last year. Finally, moving on to venture capital. Obviously, this is really just starting out in terms of growing as a program. It's just ramping up. There's no new commitments this quarter, but you're seeing in the cash flow chart that you're seeing capital called. Only 2 vintages, but neither of them have meaningful IRRs yet, as they are too new to produce actual returns. That was going to be the last of my comments, and I'd see if there's any questions.
2020 is our first vintage vintage year?
Well, we had some exposure through
Neuberger Berman previously.
But after the boards made a dedicated allocation, I think our first was innovation, right? Was it
Correct.
2020?
First
Yeah.
direct within the venture capital asset class.
Did I miss Neuberger reporting on the previous venture then?
Yeah, exactly. So we
Was
had a
it-
couple of
that was-
legacy investments through Neuberger in venture.
Yes, we do, and they do report those, and they benchmark those against the venture capital universe within the Neuberger report. So we're not able to extricate out those venture investments from that portion of the Neuberger
Okay,
program.
because in the last presentation, I didn't hear venture broken out specifically. Right?
In Neuberger's report, they did have venture.
They do report on it.
Yeah.
It's a relatively small portion,
very
about
small
9%.
piece.
What vintage? What was it? 2019,
No,
2018?
it was earlier than that. And
17 through 18 primarily.
and you remember
Any
the management?
DPI? Any DPI coming
4 or
back?
5.
Yeah.
I'm more curious, and I know it's small, very, very small, but out of curiosity, did we get DPI out of that very, very small allocation?
If you give me a moment, I can pull it up.
Yeah, can we?
There's 8.7 million of distributions relative to 33 million of commitments. So there have been some distributions.
Better than I would have thought.
It's 2017, 16, so slightly better than
Yeah.
later.
I have
Thank you.
another question. Looking at the real estate program, and it shows 2019, 2020, and 2020. It shows not meaningful IRRs. I'm not sure why that is there for the last 3 things
For
compared to peers.
21 through 23.
I'm looking.
Yeah, I can jump in on that. So the process that Makita has to report on this is that there needs to be 8 quarters of performance before they start reporting performance.
Okay.
So those haven't reached the 8 quarters just
Okay.
yet.
Any other questions from trustees? On the real estate portfolio, we approached this at the last meeting, but would you care to comment on the degree of exposure we might have to, specifically to downtown office?
Right.
And whether or not that's been, adequately revalued given current market conditions?
Sure. So we actually have limited exposure to office overall. We do an annual update on our sector exposure. So as of June 30th of 2022, 16% of the growth real estate portfolio was allocated towards the office sector, although that includes non-downtown office primarily. So very, very limited exposure, not meaningful towards the type of office that's being impacted by the headwinds. Especially recently, there's been some headlines within San Francisco, Los Angeles, New York, and many investments that are being handed back to the lenders. But within the growth real estate portfolio, it is very insulated. There is a few assets within the core real estate portfolio, but that's also an area where the exposure is quite limited. So for core real estate, we have a 15% allocation towards the office sector. That's an 8% underweight to the overall index. So less exposure, more of it allocated towards growth markets, although there are a few assets that are affected. So not completely immune, but
Sure.
less affected.
Okay, thank you. Any other trustee questions?
A bit of a follow-up to that.
Sure.
Is it possible to see our real estate exposure based on asset types like single-family, multifamily, commercial?
We do that on an annual basis, so we haven't quite updated that as of the June 30th of this year yet, but we do have that available and we can provide that.
Okay, thank you.
Okay, is that something we can review in the IC at our next meeting?
Absolutely.
Perhaps? Okay.
Okay.
Great. Thank you.
All right, so 3Ds, Eric as well.
All right. Moving on to the performance report. Go to page 5 if you're following along. Just make a few comments on the market and try to keep it relatively short. Looking at year to date, and this is through June, or actually is this? I think this
Excuse me, I hate to interrupt, but can you please move your mic closer because you're kind of cutting in and out?
Absolutely. Is that better?
Yes, thank you.
Oh, thanks. So this is actually through April 30th. So if you look at year to date, it's almost kind of the mirror image of what you saw last year. And just kind of want to put perspective. I know you've talked about it in depth, but put perspective around last year. It was in many ways kind of unprecedented. And I say that not because of U.S. equities being down 18, 20%. We expect that every 7 to 10 years. That's not really abnormal. What was abnormal was seeing both equities and fixed income down at the same time. There was only 3 other times in basically the history of the stock market going back to 1929 where you saw equities and fixed income down at the same time. So that's a very rare event. And if you look at the 47-year history of the Bloomberg aggregate, which you see is down 13%, including last year, it's only been down five calendar years. The worst other was negative 3%. So it really was an unprecedented year, and you're kind of seeing a reversion to the mean happening year to date. Overall, if you kind of extend that through the end of last month, we're actually now or last couple of days, we're now in a bull market. The market hit its low back in October of last year, and so we've had a very short bear market. The market was down about 25%, and now we're up about 21, 22% from that market low. So unbelievably, we're actually in a kind of bull market again. I would kind of caveat that, and not to be the bear in the room, or I had a client upgrade my master's degree to a PhD, and they called me Dr. Doom. So hopefully you don't view me that way. But if you look at kind of what's driving the market, there's actually 7 tech stocks that have driven 90+% of the return of the S&P 500. So it's really concentrated in terms of what is actually driving the market. If you look at how many stocks are actually producing negative returns year to date, it's actually, 281 firms. So more than half of the S&P 500 is in negative territory. Overall, the average stock in the S&P 500 is only up about 3%. So it really is a concentrated market, and it's very large. We're at pretty much the most concentrated we've been in the history, kind of going back to the telecom crisis, where if you look at just the top 5 names, it's about a quarter of the overall S&P 500. We go out to the top 10 names, about a third of the S&P 500. So a very concentrated market. And if you look at the number of firms that have outperformed the S&P 500 year to date, it's only about 25%. So I would not want to be an active stock picker in this market. You have a 75% chance of underperforming. So I just want to kind of make those general comments before we get into the portfolio. Moving on.
So I had a question.
Yeah,
I think that, or a comment, I think that the reasons tech stocks are up so much is the enthusiasm about AI. And so I think there's a question about how that will play out. I think it has huge potential, but the question is it near-term or short-term results? And then I would also comment that the Fed announced a pause in raising interest rates, but there could be another round. So that I think that, to your point, could have another depressing impact once that happens again.
Agreed.
Hopefully only short term.
Only short term.
Yes. And hopefully we get 2 weeks before anything happens.
Yes, exactly.
Although in a bit of good news, the number of stocks that have been rallying has broadened since in the last few days. So,
Yeah.
I mean, I'm more in your camp, but and I'm not sure AI is driving it. It's tough to tell at this point.
Well, I know NVIDIA is up because of AI and demand for chips and things like that.
They're up because the demand for chips is insane.
Yeah.
And that's real. That's not
That's real.
projected because everyone is investing in LLMs or MLMs, and the only processors you can use right now are GPUs because the
Right.
AI ML accelerators just aren't on the market yet. So that's real. That's not perspective.
Yeah.
And the fact that everyone knows that the Fed is going to raise again means it's priced into the market. So unless the Fed shocks you, if we expect a 25 basis point hike and they shock you with a 50 basis point hike, that's when the market can flip.
Yeah.
Otherwise, it's pretty much expected at this point.
Yeah.
If the Fed surprises you, they haven't done their job. They try to foretell their moves as much as possible. But please proceed.
Thank you. Going to page 28, looking at the current asset allocation versus target, only wanted to pull up this slide to show you that overall the program sits pretty close to target. You see some minor deviations, but very close to target overall. Going to performance, looking at the quarter as of March 31st, the overall aggregate plan was up 3.8%, 4.2% for the fiscal year, negative 2.8% for the 1 year, then very strong over the 3 and 5 year periods at 12.6 and 6.9%. What I really want to point your attention to is if you go all the way down that line to the investment metrics, public DB greater than $1 billion rank. And if you look over the meaningful time periods of 1, 3, and 5 years, you can see exceedingly strong performance, 15, 15, and 22. That's very good peer relative results. I wasn't going to go through individual asset classes or managers, but because the team on Makita's end wanted to make my first meeting a little bit more difficult than it needed to be, we did find an error in our report. If you go to page 36 with the Kotak, I believe it's pronounced, India Midcap Fund, we had the wrong peer group in this. We had the European peer group as the peer group, and we've corrected that, provided it to staff, and they will update the reports, the public reports as well. But we did find that error, so I want to make sure we did note that before we moved on. Going to what I think are the most interesting pages, kind of gives you the glimpse of the overall plan and kind of the decisions that you as a board, staff, your consultants, and asset managers have made. That's kind of aggregating it all together and then looking at how efficient it is relative to peers. If you look, this is a 1 year period for the returns, which is the far left. You can see that the plan is in the top quartile in terms of the returns it's generating. But more importantly, if you look to the next column, the next set of stats, you can see that in terms of the risk it's taking to earn that top quartile returns is right about median, actually slightly below median in terms of overall risk. And so that's a very advantageous or, a spot you really want to strive to be in, which shows up in the next two charts, which is the Sharpe ratio and the Sortino ratio, where you can see you're in top quartile in those. So that's return per unit of risk, essentially how efficient the portfolio is. And you can see that the portfolio is highly efficient, not just relative to peers, but just from an absolute standpoint. Moving to 3 years, very similar results. You can see that the plan is in the top quartile. And again, risk, in order to generate that return, was sitting right about median, which generated top quartile, right at quartile, top quartile Sharpe ratios. And then the 5 year, which by the time you get to 5 years or so, take out any luck or investment noise, or most of it. Again, you still see the same theme though. You see returns top quartile, and then risk, still below median, almost bottom quartile in terms of risk, and then top quartile Sharpe ratio. So a very efficient portfolio. So that's my big takeaway. These are the charts I tend to look at when viewing the overall portfolio. I think too much time often with different plans. Not so sure about this plan. It gets bogged down in individual managers, but this is really what you should be paying attention to.
Question for you. First of all, our risk reward, to just dumb it down, is amazing. So congratulations to the staff. I mean, this is the work that we've been doing for 4 years to change the governance and investment policy and delegation to the CIO and a lot of moving the battleship. So it's really great to see it manifest. We don't get any guidance on how much risk we should be taking from other stakeholders who could help us understand what our bank looks like at the poker table. So in the absence of that, we have worked with Veris to try and come up with our own sense of what's a responsible risk level. Given how good we've been, would you increase the risk?
That's a very difficult question.
It's an unfair question.
It is, especially for my first meeting. Very, very difficult question. I would look at the return you're generating, and I would argue that that return is relative to what you need to become fully funded and what your funding needs are to meet contributions is significantly high enough to meet those needs. Now,
I think Eileen's dying to answer that question.
I'm going to ask her too.
Which she will soon.
Yeah.
It's unfair to ask him in his first meeting, but it's not unfair to ask Eileen.
So I would just argue you're generating the rate of return that you need. You do have a low risk portfolio, so there's always trade-offs, and it's investments. There's no right answer. There's always trade-offs.
Agreed and well said. Eileen won't get off that easy though.
Watch out for the next meeting.
Were there any other questions on the performance? If not, I'll move to the healthcare, and I'm going to be very quick on this one. Actually, real quick, asset allocation, very close to target, so no big deviations there. You do see a little overweight to core real estate. That's the little bit of private within the portfolio, and just because of the lag nature and appraisal nature, it is slower to adjust versus the rest of the portfolio being purely public, and so you do see a little bit of an overweight there. Looking at performance, quarter to date, 4%, fiscal year to date, quite strong, 5.6, 1 year, negative 4.3, and then 3 year, 9.6. I don't actually tend to look at the peer rankings with health and welfare funds. The liability structure of the different plans are so diverse that I don't think it's a kind of a fair comparison versus what you get with a traditional pension plan. So just to point them out, so we're not hiding. Fiscal year to date, 11th percentile drops to 60th for the 1 year, then back up to 10th percentile for the 3 year. And I was just going to leave it there, unless if there's any questions. I guess I should show you these charts. They're less flattering, but that's because of the peer group more than what you're actually seeing if you look at the Sharpe ratio. If you look at the 3 year Sharpe ratio, still very strong Sharpe ratio, so very efficient portfolio.
Great. Any questions from trustees? Okay, thank you so much.
Thank you.
All right, thank you, Eric. It was a
You can
great
report
first
that you
meeting.
escaped unscathed.
Thank you.
All right, so we get to 3F, and I'm going to invite Veris. And this is a very important agenda item. So about once in 5 years, we poll our stakeholders. Well, we poll our trustees. We try to poll our other stakeholders.
Have we tried to poll our other stakeholders?
We did last time, but we drew a blank there. So this time I'm not sure. So Eileen can educate you on that. But nevertheless, this is important because, return follows risk. Based on the risk you take is how much return you can get. And we have operated with an absolute risk level of 12% based on the work that we did 5 years ago. And so it was time to revisit that, which is what Eileen and team have done. And there are some really important takeaways here. So with that, I'll turn this over to Eileen.
Well, thank you, Prabhu, and good morning, trustees. And thank you, Trustee Chandra, for kind of setting us up. Appreciate that. Wasn't planned. I'm going to go into full screen mode, so hopefully, yep, there we go. So we are going to, Eileen Neal at Veris, and my colleague Mark Gazelle, who is also a consultant and part of our risk team at Veris.
Excuse me, can I make the same request of you? Can you move your mic closer?
Okay, well, is that better?
It's on, yeah,
Just a little.
Okay,
Yeah.
just a little better? I feel
Yeah,
like
just a
I'm
little better.
booming.
You're still a little quiet. Thank you.
You're welcome. So as you all know, we, every couple of years, we recommend actually revisiting the risk profile on a sort of go-forward basis, which reflects the risk tolerance and risk objectives of you as trustees for the fund. And so we undertook a survey, so we're going to provide you with the results of the survey, kind of remind you of the process that we undertook. And we'll focus on the key takeaways. We do in the appendix have the detailed survey questions and responses for your information, but we won't be covering those in detail. And then we do have some so overall concluding comments as well as recommendations regarding the risk limit. And why is that not moving forward? That should control it? No. Okay, I'm going to have to. Doesn't. Okay. Sorry. I'm going to have to not be in full screen in order to control the slides. So in terms of the survey process, we did this exercise back in 2018, where we spoke with you all individually, as well as I think ultimately collectively collected information similar to this process, and arrived at that time at the risk limit objective or risk maximum of 12%. And our view is that, you know, setting your risk tolerance for a fund is reflective of a long-term objective, and so as such, it should not be revisited more frequently than, say, anywhere from a 3 to 5 year period. 5 year probably optimal. So we're at that point now, and in November, we distributed a survey via SurveyMonkey to both all of you as well as the police and fire trustees. And we did have a good response rate. Basically, out of the 15 trustees, we did have 12 respondents. And in addition to the survey, which was quite detailed, we did conduct follow-up interviews with about 50% of you that expressed a desire to discuss the survey and your responses and thoughts in more detail.
Before you go much further,
Yeah.
can just have some clarification on what the 12% means? Is it the standard deviation of the volatility within a single year, or over 5 years, or how will you define the 12%?
Yeah, so very good question, Trustee Horowitz. Thank you. The 12% risk limit would apply to at any point in time because it's based on forward-looking risk as opposed to the standard deviation of returns that Makita shows is basically backward-looking, what we call ex post. So that is your actual risk experience, which in large degree is going to be driven by not just the decisions you make, but the level of risk that is present in the market, right? So if you think about measures of risk, like for the S&P, it's the VIX, right? That tells you what the actual current, ex post risk is, or ex ante risk is in the market, so forward looking. So when we're setting this risk limit, it's on a forward looking basis, but we're monitoring it, as you know, we're actually monitoring it monthly along with your Chief Risk Officer, Eric, as well as presenting to you quarterly what that forward-looking, what the market is telling, what's built into all of the markets in which you invest on a go-forward basis at that kind of point in time, based on more recent signals related to risk, if you will, without going into a lot of the details. So it's any point in time. It's a limit. So you're setting your limit, and the purpose of the limit is if in fact you exceed it because of, again, perhaps what we're seeing in the markets, that may prompt a decision at that time. The purpose of it is to prompt a discussion, a review, and a decision about, do we want to maybe go a little bit more risk off so that we're within our limit if we find ourselves outside of that limit? Because that is sort of the maximum risk we all collectively decided we were comfortable taking. And I don't know if probably.
But that number is an annual number.
Annual number.
Yeah, it's a standard deviation and it's annual. But
it's annualized.
Yeah,
yes.
annualized. And so, as Eileen, not to get technical, but ex ante means that looking ahead. So when we build our asset allocation, we use an ex ante number of 12%. In the hope that future risk patterns will follow the past, and it may not be. So I look very closely at ex post because I actually want to see what our realized risk is. So that's something that we track as a group as well.
So if it's analogous to something like the VIX, so that means we might momentarily exceed, and by momentarily I mean days, weeks, or months even, but certainly weeks where we exceed the 12% and then fall back. This doesn't concern us at all, or what do we think about the fluctuations in a number like VIX?
Yeah. I mean, that's just one part of the equation, right? Just looking at the VIX. And it's not that it doesn't concern us. I think we should certainly look at it every time it breaches the 12%. But it's a very imperfect science, right? And even the calculation of the risk number itself you can question, right? This is really 12%, right? I mean, we think it's 12%. So it's a multi-factor approach. It's based on the Barra risk model. And so it's in general, risk systems tend to be more stable than return predictions. So you would think that in the long run that it holds reasonably. But why this is all important, and Eileen will tie this in later, is does it put stress on our sponsor? Otherwise, we don't care. I mean, I could be at 15% risk because I can get to a fully funded ratio much sooner with a 15% risk level than a 12% risk level. But we're also cognizant of the stresses that it puts on our sponsor, because if you have a 15% risk level as opposed to a 12% risk level, in the event of a drawdown, we will lose a lot more money, and therefore the contributions from our sponsor are more, which impacts the sponsor a lot. But just to make Harvey happy, I will say that we always put our beneficiaries first. We are fiduciaries to our beneficiaries, and everything else is secondary.
Thank you for those clarifications.
Yeah. And I think it's also important to understand this is a limit, and the objective is to set it above your target risk exposure, which was the case when this was set back in 2018. your actual sort of target risk exposure as a result of your asset allocation at that time was less than 10%.
Yeah, exactly.
And we're going to touch on that in a moment. So the focus of the questions in the risk tolerance survey was to basically help us understand these 5 categories related to ultimately the factors that determine that limit or appropriate limit for this fund. So we explored we tried to glean from you all what your individual objectives are as they're related to risk. Is it, in fact, to improve your funded status or to exceed the discount rate or assumption or whatever? We gave you choices and then you ranked them. And the same was true with risk priorities, time horizon, and we focused on time horizon from 2 categories, if you will. You as a board set the strategic direction of the fund, so there's a time horizon associated with that strategic objective, but then staff has been delegated implementation authority. That's the activities associated with identifying managers and strategies to implement to ultimately achieve your objective. So the time horizons associated with those 2 important decision-making components. And then investment philosophy. What are your respective views? Where are you on a spectrum, if you will, with different investment approaches that ultimately feed into your risk tolerance? And then lastly, governance, because the board governance drives or facilitates to some degree your ability to take risk and how you take risk. So those are the areas that we focused our questions. And so now we're going to just provide you a summary of what your responses collectively reflected in those 5 areas. So with respect to risk objectives, you were pretty unanimous. In fact, this board and the Police and Fire Board, I think we're also unanimous that the most important objective with respect to risk-taking is to improve the sustainability, the long-term sustainability of the plan. So focused on that funded status volatility and to meet or exceed the plan's actuarial rate of return. So those you all unanimously responded were your main risk objectives. And as a result of that being your main risk objective, you indicated a willingness to actually maintain your current risk target. And remember that you just set in this past May as a result of the asset allocation exercise you went through, or even increase your current risk target. So there is a very healthy appetite for risk taking that you expressed as a group because of that focus on enhancing the sustainability, the long-term sustainability of the plan. However, you also indicated that that notwithstanding, that you are concerned about return volatility and drawdowns, that would be sort of a secondary consideration in terms of your risk objective, is to have a focus on managing the risk in a way that you're focused on the drawdowns associated with your risk targets. You also indicated that you're not too concerned with what we call headline or maverick risk, or even illiquidity. So that's important because that factors into, again, the types of risk exposures that you're willing to accept in the fund. With respect to time horizon, again, as a group, you believe that staying the course, setting that strategic objective and then staying the course over a long period of time was really how you wanted to reflect your strategic decision making. So not interested in tactical decisions or tactical deviations once you've set that strategic objective. And The time horizons were sort of split. Some of you said, 3 to 7 years was appropriate for reevaluating strategic decisions. And then there were some of you that said, 10 years and greater than 10 years. But what those responses reflected was actually in conflict with what in practice you do. And that is that every year you're taking a fair amount of time to revisit that strategic decision through the asset allocation setting process. I mean, that's why we started that back, I think, in December and just finished that in May. Yet your responses were, well, actually, we should be doing that maybe at least 3 years, if not more, like 5 to 10 years. And so in discussions with staff about the results, we recommend that you align your practice with what you indicated is actually your time horizon for making the strategic decisions, and that is maybe moving to a 3 to 5 year cycle for setting that asset allocation target. If you were to do that, you actually would be in line with your peers, because your peers typically revisit that decision to the depth that you do annually on a 3 to 5 year basis. And so that's one recommendation that comes out of our review of your survey results. The second component of time horizon is that implementation decision. And you were pretty uniform, as were the fire and police, that, while we revisit our strategic decisions every, let's call it 5 years, we want to review that implementation decision maybe in a shorter time horizon. So more like 3 years. And actually that, again, is appropriate to have a shorter time horizon associated with implementation, because strategic is your long-term, what really drives your asset allocation. The majority of your return and risk comes from that. But your implementation decision does afford some flexibility in terms of maybe either tactical implementation or certainly changing out strategies and monitoring those strategies and the efficacy of the decisions associated with implementation over a shorter time horizon, 3 to 5 years. And that is appropriately captured in your investment policy and aligns with practices for monitoring those decisions. In terms of investment philosophy, it was interesting that a majority of you indicated that in addition to your strategic decision making, which is setting your, quote, beta or market exposures, that you did believe that you can actually achieve alpha to help close the gap or enhance the return relative to that actuarial return rate, which is currently 6.6%, which happily it looks like you're going to exceed this year, right? So that's an important data point, because that feeds into the fact that you do employ currently a combination of active and passive strategies. Also, most of you indicated that you're comfortable with the current program of reflecting a complex mix of different strategy types and multiple asset classes, that you're comfortable with having a lot of diversification and so forth. So that confirms the actual program structure and implementation. And then you also indicated, though, that you realize there's some areas where taking active risk and believing that, or having a conviction that alpha can be generated from that active risk is really more associated with the private markets. So not so much public markets, but in the private markets. And certainly your program reflects that. You have a large passive exposure in your public markets. And then you also were pretty tight around that level of alpha that you expect for active risk. And basically that's a 30 to 60 basis point range. And that is, for a fund of this size and complexity, that is unacceptable from our perspective as sort of practitioners evaluating lots of funds performance. That is a reasonable level of value added. It's probably a little more on the conservative side, and it's probably lower than what you can achieve, what we would expect the fund to achieve. And then lastly, the governance structure. Everyone expressed a high degree of comfort with the fact that the strategic decision is the purview of the board, but implementation decision, the purview of the staff, and there was a lot of confidence, again, very uniform in terms of the confidence in the implementation abilities of staff. So that, from a high level, is what we gleaned from the results. Now, as Prabhu alluded to, it wasn't just the inputs that we derived from your responses to our surveys, but we actually went to your actuary and collected information related to the liability side of the fund, because your risk limit that we're talking about today has to be reflective of the holistic picture, not only the strategic decisions that you make, but the implications or the ramifications on the ability of the sponsor to be able to continue funding at the risk level, if you will, that you all have determined that is appropriate for the fund to reflect. So I'm going to turn it over to Mark to help you understand how we integrated that information into the responses that we received to you from our survey.
Thanks, Eileen. So the next few slides, we're going to take you into the weeds a little bit, really just to demonstrate support for a recommendation we're going to make to adjust some of the risk limits expressed in the investment policy statement for the reasons that Eileen has already covered. On this page, the framework, I think you've seen this before, but it shows the role played by those limits, specifically how total fund volatility limit, which, as you know, is now set at 12%. And that number, it sort of fits into that box at top, which is the volatility of the total fund. But you can look at that as an expression of the board's risk tolerance, which you see there in the box at the lower right. And it also acts as a control on the metrics that really matter most, in particular future funded status, which is that box there on the lower left. On the next page, so in addition to that overall 12% risk limit, the investment policy statement currently lists a few other related risk metrics, among those that relate most directly to the sensitivities expressed in the survey, are a 5% probability of falling below a 60% funded ratio, and a 30% average of the 3 worst historical drawdowns in the risk model. And today, we are recommending that those limits also be adjusted in order to stay in alignment with the total fund risk limit. We show this on a subsequent page, but here on page 7, with Chiron's assistance, we're showing you where you currently are in relation to those limits. And I'm just going to hit a couple of highlights here. A particular interest are the top line of the top chart there, where it says baseline. You see the funded ratio of 57%. And that simply means that, you know, that 60% limit doesn't really make sense at this point. So what does make sense is the 47.7%, or let's round it up to 48%, you see on that 25% drawdown line. So, and I'm going to explain why that makes more sense. Because on the next page, we're going to show that there is less than a 5% chance of a 25% drawdown at the 13% risk limit. So if you look on page 8, and you go down just below the red line, it says 13% risk, and you see in that first column, it says minus 22%. So that is what we call value at risk, or VAR, or VAR for short. So 5% of the time, your return is going to be better than minus 22%. So as you see, 22% falls between 20 and 25% we saw on the previous page. So we're going to recommend basing the new funded status limit on the 25% drawdown scenario so that it is not actually more restrictive than the 13% risk limit, which is the board's primary metric for controlling total fund risk.
And it's important to remember that, again, when the 12% current limit was set, your risk target on a go-forward basis was 9%. Today, under the new policy, you're actually setting a target at, it was 12.1% to be specific, but your target is now your limit. And remember, we want the limit to be above your target so that there is room for when you do have some volatility that, you know, there isn't a requirement, or there wouldn't be a requirement for you as a board to revisit that risk exposure or your asset allocation. So by setting the limit higher, and we're not giving it the kind of spread that we gave you before, because when you look at market volatility, that 13% is it's a lot higher. And so your target is higher. And again, that's reflective of your collective view that we're willing, because we have a very long time horizon, we're willing to take as much risk as we can, being cognizant of these drawdowns, potential drawdowns that entails, that Mark just covered. So we think a 13% does give enough room, at least based on where we see risk levels today and what the recent experience has been, to give you some cushion so you don't have to be revisiting your strategic target in a short-term period. So that is a recommendation that we are making, in addition to revisiting your investment policy statement with respect to the level of drawdowns and the probability of falling short of your funded status.
May I ask one question? So at police and fire, they stayed at 12%, and the recommendation from Veris was at 12%. Here for Federated, we're less funded. And so could you explain the rationale for suggesting a 13%? I understand that the two plans are different, but could you give us a rationale?
Well, that is the rationale. The two plans are different, and their current risk target that they set is at 11%, while the asset allocation that was set by Federated last month is actually at 12%. So the risk limit of 12% is okay for police and fire because their risk target is below that. They have a cushion. But for Federated, because the new risk target is actually 12%, they need a higher risk limit so that there's some cushion for fluctuation around that target.
Can I also add to that, Eileen? So, Council Chin, so what it means is, you know, the higher your funded status is, the less risk your plan needs to take, right? So as you get close to 100, I think Harvey's mentioned this before, you don't need to take as much risk, right? And so given the fact that Federated is less funded, there is room to take more risk. Whether it's actually exercised or not is a different question, but there's certainly room to take more risks.
I see. Okay, thank you.
And then just a couple of points on this page, and then we'll get back out of the weeds, is if you look at that first column, the difference between 12 and 13%, in terms of drawdown is a minus 20% drawdown versus a minus 22% drawdown. So I just like to highlight that this is not a large adjustment. It's a marginal adjustment. And then on the 13% line, all the way to the right there, something else we need to clean up in the IPS is that under our modeling, the average of the three worst scenarios is not minus 30% as it is in the IPS. It's minus 36%, so that's also going to be part of our recommendation. And then briefly, in case you're wondering what those three worst scenarios are, they're shown here on the left side of this page, page 9. It's COVID-19, of course, the the long bear market that followed the dot-com crash in 2000, which was followed by the build-up to the Iraq War. So that was a long bear market. You see that about 2/3 of the way down the page, and then finally at the bottom, the global financial crisis.
Mm-hmm.
On page 10, so we're back out of the weeds, and here we recap that the survey indicates that concerns over total fund volatility are secondary to concerns over failing to achieve your actuarial discount rate. Additional support for setting the risk limit at 13% is provided by the fact that, as Eileen said, the current 12% risk limit was established when the total fund risk was significantly lower than it is today. And then finally, the recent strategic asset allocation review that you did with Makita showed that the board is comfortable with the current asset mix, and the risk level of that mix is just north of 12%, which indicates to us that the 12% limit is set a bit too tight.
So our recommendations are summarized on slide 11. These are we're comparing the current IPS risk limits to what we recommend. So increasing that risk limit from 12% to 13%. Increasing or changing the funded ratio tolerance from falling below 60% to falling below 48% at the 5% probability level. And then lastly, as Mark indicated, because you adopted a higher risk target, the drawdown exposure is greater than negative 30%, and so we recommend increasing that to negative 36%. So in terms of our conclusions, one thing that's difficult when you're setting both the strategic asset allocation or making any sort of strategic decisions about the fund is how much consensus there is in support of those decisions. And I think the good news is your survey responses indicated that there is a high degree of consensus in terms of the risk appetite of this fund and the board, and that it is high, and that you all similarly have the same or very unanimous in terms of your risk objective, and that is ensuring that the asset allocation supports the ability of the fund to ultimately meet its objectives of providing for the retirement of the fund participants and in exceeding the discount rate assumption of the liabilities. There also appears to be a lot of consensus around the comfort with the complexity of the current fund, which if you do have a higher risk target, you do typically need to have a more complex fund so that you capture more of those strategies that are likely to meet your overall return target and your risk target. And then lastly, obviously, with the changes we're recommending, that does entail revisiting your IPS language to align your IPS language with both these recommendations as well as our findings in the fund, particularly as they relate to the length of time associated with that strategic decision-making changing from the annual to a longer-term horizon that's more in line with your peers. So that really concludes our comments, and obviously happy to entertain any more questions either about the results or about maybe our thoughts on.
Great, thank you very much. This is, as our CIO indicated, extremely important. In a lot of ways, deciding our risk is the whole ball of wax. Mm-hmm. So with that, any questions from trustees?
I have a question.
Please.
So I understand the argument for having a risk limit, over the risk tolerance, but I wonder.
I'm sorry, can you speak more? I can't hear you.
Can you hear me now, Judy?
Yeah, thank you.
I understand the rationale of having a risk limit over the risk tolerance, but I wonder what are the implications for the discount rate? Are we moving towards increasing the discount rate in the future?
Well, I think the two are separate decisions. I don't think one is linked to the other.
Yeah.
So, I mean, it's for the board to decide, but I don't think the two are necessarily tied together.
I think they're related, but I think we set them separately. So if we, for instance, were to adjust upward the limit and then act upon it to actually increase our risk, therefore hoping to generate higher returns, then we might increase the discount rate. But that's at least a three-step process to get there. And we haven't done that in recent years. So I think with the discount rate, and that will come up in the fall when we do our annual review of that, we are looking both at our expected earnings in the future, but also our past performance. So we've been slow to modify our discount rate.
Thank you.
Yeah.
Is
I
that
mean, I
fair-
think,
is that a
yeah,
fair
that's
characterization?
That's well said. But the implication is we're not increasing the risk limit as a precursor to increasing the discount rate. So that's.
So if I may, Mr. Chairman.
Please.
Hi, Harvey Lederman. You raise a very good chicken and egg issue here that appears in the survey results. And I think we need to make sure the board understands what is the chicken and what is the egg. And it's this. It appears that there's a perception that we have an actuarial rate of return that's kind of this bogey out there that we're trying to skate towards, and we'll adjust risk so that in return to meet that.
Harvey, you're cutting in and out.
That's really upside down.
Thank you.
The actuarial rate of return derives from the board's risk return analysis. In other words, what is our tolerance for risk and what we want to peg for a return for that? Once that's established, then the actuary will say, well, if that's how you're going to invest the assets, then we're going to set the assumed rate of return on those assets based on your risk return tolerance. It's totally derivative. It's not something that we derive risk based upon. It's the opposite. So the board should set its asset allocation based on its assessment and comfort with how much, modern portfolio theory, how much on the efficient frontier, how much risk are we willing to take, assuming we'll get so much return for that to fund the system. And then the actuary will say, well, if that's how you're investing your assets, then yeah, I'm going to assume your rate of return is a little bit less than that because I want a cushion of comfort in there to make it. So it appears from the survey that your responses have it upside down. This last one says, drawdown risks or concerns, but falling short of the actuarial assumed return is a greater concern. The actuarial rate of return is not something you skate towards and adjust your risk and return assumptions based on. It's the other way around, and I think the board needs to understand that we don't arbitrarily set some assumed rate of return actuarially and then decide how to invest the assets accordingly. We decide how to invest the assets on a risk return analysis, and then the actuary derives the assumed rate of return from that.
Mr. Chair, if I can make.
Please.
I think what you're saying is true, except for, I think, one very important concept, and that is when the actuary sets that actuarial rate of return, because they are looking at what the strategic asset allocation target return is, the actuary is setting that based on their time horizon for the plan, which encompasses 30 to 50 years, let's say. It looks at the time horizon associated with the period over which benefit payments are going to be made to current plan participants. And that's a very long time horizon. Now, when you set your asset allocation target, it's a long time horizon, but it's 10 years, right? So I think the way that I think about exceeding or focusing on that assumed rate of return is that assumed rate of return does in some way capture the other things that are important, and that is, you know, the funded status, volatility potential, and the potential for falling short of meeting those benefit payment obligations. So when the board is setting its strategic asset allocation, it's changing it over time with the eye of ultimately fulfilling those objectives, which are, you know, basically reflected in that actuarial return. So I don't think it's so much chasing that so much as, okay, that kind of reflects that very long 30 to 50 year time horizon of being able to meet those obligations, and the board is striving to achieve that objective, and so it's just a quantitative reflection of that objective. That's kind of the way I think about it.
Yeah.
If I could comment, I would maybe take two caveats in what you just said. For the actuary advises us on the expected rate of return, but ultimately it is voted on by the board, so the board sets that as a number. And secondly, the risk target maximum ceiling is not necessarily something we implement.
Right.
And in fact, what you just observed was we originally had a risk ceiling of 12%, but we were only taking 9.5% of that. And as a result, had commensurate much lower returns that a lower risk target would imply. But I think personally, just having participated in the process over the last 3 years, I don't think it's quite so linear. I think it's kind of a fuzzy, recursive process. We're thinking about all these things at once, not necessarily one deriving from the other, but I think the goal is to have some level of conformity, that we're setting a risk target and we're setting an asset allocation in a way that justifies or makes reasonable the discount rate, and we're willing to modify any one of those elements if they get too far out of line with the other. So that's the way I personally view it. But perhaps my thinking is more fuzzy than most.
Yeah, I have a question, and mine is that if we're at 12.1% risk right now, we're over the 12% limit.
Right.
And do we have to, if we decide not to raise our risk limit, do we have to go back and change our asset allocation to make sure that we're under that 12%?
No, the board approved the 12.1%. So there's an implicit decision by the board that we are over the 12%.
Yeah.
And it's not such an exact science that I would
Right.
worry about 10 basis points.
Yeah, I mean,
but-
that's the other way
yeah,
to look at it,
yeah,
though, right? You have to go back and say,
yeah.
our decision was wrong.
That's right. And the other thing is, of course, and I told this to the police and fire board, and the two plans are different. In general, I like them to be similar, but I think there's a good enough reason here for it to be different, is that if I think that this is some market environment is an ideal time to take more risk, this is the board's decision to set it at 12 or 13, and I can make a case to the board that we should be more aggressive in our investment investment decisions, which actually require an ex-ante risk of 13.5 or 14%, and the board can quickly change that. So that I think the board, and we did that in March 2020. I mean, we were still within the limit, but we quite drastically increased our risk limit, right? So, but going back to Harvey's point, I have to say, and to Trustee Avasti's question, right? So if you look at our expected rate of return now, based on the amount of risk that we are willing to take, Makita's return assumptions show greater than 8%, and our discount rate is at 6 5/8. So when you all discuss the discount rate decision in the fall, something to keep in mind. I'm not recommending that it should be increased, but so Harvey, I think in reality I mean, they're all interconnected in some ways, but I think when we set SAA, our strategic asset allocation, we are looking at the risk limit and coming up with it, not necessarily trying to be guided by the discount rate. So I think it's more dependent on the risk number and Makita's capital market assumptions. But of course, if the discount rate is 1%, obviously it's going to have a bearing on how I think about assets. But sort of we're usually in the ballpark of the discount rate, but for the first time this year, there's quite a gap between the expected return and the discount rate.
Look, my 2 cents on this is, I think Harvey's made some good points, and ultimately, I agree with Chair Horowitz that, they are interrelated in a way it's hard to make it linear. But our job is to keep it simple. We need to take as much risk as possible without tanking the plan to get to a much better funded status, because our funded status is not good. That is I think that's the North Star for this discussion.
Good point. That's a very good point. And may I just ask one question?
Sure.
Does the recommendation, Eileen, to increase the risk tolerance by this amount get as granular as targeting where that risk should lie in the portfolio?
No, this really relates solely to the overall asset allocation objective.
And following up, I think, on what CIO Polani was suggesting, help me understand, in the case of a drawdown, as we experienced in March of 2020 with the onset of the COVID crisis, a measure like the VIX went up drastically. There was more risk in the system. And yet, to me, and to my simplistic thinking, when asset prices decline sharply, there's less risk going forward. So how do we account for that reality?
Well, when they decline, there's typically more volatility associated with them.
More volatility, but I would say less risk if you're a buyer.
It's a short-term, long-term.
Yeah.
So the VIX is based on trading in the options market, so it's very short.
And risk has so many different definitions, right?
Well, I guess for the sake of this argument or this discussion and where we set our limits, did our risk profile increase in March of 20?
Well, yes, it did. Because if you have a bear market, which we did in 12 trading days, the fastest bear market in history, that implies extreme volatility. And the way we calculate risk here, your risk does go up. But to your point, assets were on a song,
So if we were to want to take advantage of such a situation in the future, should one occur, we would need to raise our volatility or risk limit in order to be in a position to leverage such a circumstance.
You would.
That's great.
But we sort of did that, right?
We acted anyway.
Yeah, we did exactly that, right? We have a strategic asset allocation, and when our CIO came to us and said, look, I think there's an event-driven rationale for making a change, we made the change.
And you weren't precluded from the limit because you had a comfortable margin with which to work. And that's why we're recommending a higher limit, because that type of market environment, while it doesn't come around frequently, you do want to be able to be nimble and react quickly and not have to revisit because it's a policy, you would be breaching a policy threshold.
So
Can I ask a question?
Sure, go ahead. I just wanted to summarize what I just heard. So in order to make our policy comport with our actual actions, we would want to increase the policy limit to 13%.
Correct.
Okay, go ahead, Trustee Jennings.
Okay. If you go to page 11 and you look at the funded ratio, it says our current 12% one, 5% probability of falling below 60%. Now, the funded ratio is not the unfunded, it's the funded. It's where we want to be. Like, we want to be at 100 if we could, right? And our funded ratio is, what are we at as unfunded? Are we at 50?
We are in the 55, 57%.
55.
For funded.
Funded, that's funded ratio.
That's
Yes.
funded.
Yeah.
Okay,
This is
this
is a 5%
at
probability
the
of falling below that. We're already below that.
Right.
I think that's the
She
point.
said unfunded.
Well, the
We were
funded
clarifying.
ratio Yeah, we're below that. We're at 55. But if we go to the 13%, we have a 5% probability, which is very low, of falling below 48%. Is that true? Am I saying that right?
Yes.
Yes.
exactly.
Yes.
Okay, so we're adding more risk, and thus we have a higher, we have a 5% chance of being at a lower funded ratio.
Correct.
What's
Yes.
that? Yes?
Correct.
Yep.
Okay, I just wanted to make sure I'm reading that right. Thank you.
Although I would just amend, we're giving ourselves the possibility of adding more risk. We haven't added more risk.
Yeah, I know. I'm saying if, right?
Okay, just
I'm
wanted-
just reading it.
I wanted to be clear on that small point.
Well, are we ready?
Are you ready?
Ready for what? Do we, so
It requires action.
it requires action here,
It's the
okay.
thing.
Per
Yeah.
action.
And the
so-
action specifically is to amend the IPS to comport with what was on slide number 11, Or- to increase the absolute volatility ceiling to 13% and to make these other modifications as a result.
That is correct.
Okay. Is there a motion thus?
I'll throw it up. Let's, so move to increase from 12% to 13%.
So we have a motion from Vice Chair Jennings. Do we have a second?
I'll second it.
We have a second from Trustee Abbott. Is there any further trustee discussion?
Yes.
Okay.
You had mentioned increasing the time period in which we review strategic asset allocation. You didn't include that in the recommendations. Just curious, is there a reason why? It's a topic that we can revisit. I would like for us to revisit at least to start at the IC, but is it something that you might suggest we consider now?
I would say yes. I guess we didn't because there wasn't a discrete sort of number associated with it, but your responses indicated, 3 to 5 years, and that is the industry standard. So if we were to make a recommendation, our recommendation would be to revisit it in that, 3 to 5 year time frame.
It's not actually in the conclusions on page 12. So next steps, meaning.
So you can make the,
You want to amend the motion?
to make, yeah.
You can amend the motion, although I would encourage you not to. Let's keep that as a separate issue, if I may make that statement as chair.
I had no intention to. I wanted to understand. Veris felt fairly strongly about it, and I did. And yeah, it's a topic that I think we will agendize.
Okay. Fair enough. We haven't really had a discussion about it, so to include
Yeah,
it
it
in
would
the motion,
either be
yeah.
that or to spend real time now having a meaningful discussion about it.
So the motion stays as is. We probably have an action item for the future to discuss that issue, perhaps at the IC. First, is there any further comment or discussion?
So I will, on the second point, I can bring language to the IC in August that amends the IPS to reflect Veris's observations and conclusions, and then we can have a discussion at the IC.
Great.
Is there any public comment on the motion? Okay, hearing none, we will have a roll call vote. Vice Chair Jennings,
Aye.
Trustee Chandra,
Abstain.
Trustee Abbott,
Aye.
Trustee Avasti,
Aye.
Trustee Linder,
No.
no, and I vote aye as well. So it does carry. Did I miss someone? Did I get Trustee Avasti?
Yes.
Okay. So Abbott, Avasti, Jennings, and Horowitz.
411, right? This is my count.
Yeah. So the motion passes, if only narrowly.
Oh, we're missing a trustee. I was wondering why we didn't get to 7. Okay.
Okay. Oh, great, thank you. This has been very, very important and interesting.
Thank you all. Appreciated your questions.
Thank you, Veris. Actually, we do have one more agenda item in investments,
Okay.
but we will keep it very brief. Over to Ron Kumar for 3G.
Oh, this one.
packet, you have a memo regarding 7 subscription vendors that we're asking to add funds to for 1 year. These are data service.
Can you speak into
I'm
the
sorry.
mic?
These are 7 vendors that provide data services to the investment program. We are asking to add funds for 1 year to continue the services. The fees are divided equally between the police and fire and federated plans, so I can take any questions if you may have.
And these numbers are the total, so we are paying half the numbers.
So the last column is the federated portion, the very far right portion.
Oh, I'm sorry, I'm only looking at the agenda. Okay, thank you. My bad, I should have looked up.
Any questions from trustees?
I'll make a motion to approve.
Okay, we have a motion from trustee Chandra to approve.
I second.
We have a second from trustee Avasti. Any further discussion? Any public comment? We will call the roll. Vice Chair Jennings?
Aye.
Trustee Chandra?
Aye.
Trustee Avasti?
Aye.
Trustee Abbott?
Aye.
Trustee Linder?
Aye.
I vote aye as well. Motion carries.
Thank you.
Okay, we are on to no old business. We come to new business. We did not take a break at the 10 o'clock hour, as is our custom. Is there any desire to take a break now, or should we proceed?
Soldier on.
Okay, we're going to soldier on. And that brings us to 5A. Mr. Pena, an oral update, please.
Thank you, Mr. Chair. Just a few comments, if you bear with me. Prabhu was correct. Prabhu and I actually attended the San Jose Retired Employees Association meeting last week and made a presentation. We were introduced by Trustee Linder, and it's funny how things I remember. We did get some very interesting questions. I always felt that my questions were a little more difficult than Prabhu, but that's not what he remembers. There were some issues that were raised regarding the hybrid approach that we have at the office of of employees working, and so I was very clear that we have decided to continue the hybrid approach. We have staff coming to the office 2 or 3 days a week, and that will continue going forward. Some of the retirees were less enthusiastic about that. They would prefer that we go back to the office 5 days a week. Just wanted to share that with you. But we always appreciate you were going to make a comment?
Well, I'm just wondering, is that because they felt they weren't getting the service response that they
Yes,
felt they should?
there were some concerns. I think some of them, first of all, had more to do, some of the examples early in the pandemic. For example, one of the comments was related to you're only going to pick up the mail 1 day a week, which, well, we did that early on in the pandemic. We changed that through the pandemic, and of course, it's no longer the case. Some concerns about getting staff on the phone, which, you know, the reality is that we have, sometimes it may be a little more difficult to get staff on the phone, but that's whether they are at the office or they're working from home. So, you know, at the end of the day, I asked them if they were receiving their monthly stipend or benefits timely and correctly, and they agreed that was the case. But, you know, we did make the point that I was going to share that publicly with the board, with staff, although we feel, based on the experience that we have experienced the last 3 years, we feel strongly that the current approach that we have implemented is working. And of course, we always reserve the right that if we feel that it's no longer working for the members, we have the right to call the staff back full-time at the office. They are working full-time. I cannot emphasize that enough. They are working full-time. It's just that some days are at the office, some days at home.
I think mainly on that, I strongly support that, as you can tell, the hybrid. I think it's just really important that when people are choosing to retire or making those decisions or need to talk to a benefits analyst, that they are able to contact someone. And if that's on the web where they, you know, but it just needs to be real time. I think if we maintain that, then we're doing the service we need to, because they're getting a live person that they can work through the multiple questions they might have.
Yes, no, I agree completely, and that's our goal, and that's what we are shooting for. Barbara, do you have anything else to add on that issue, or?
No, I think you covered it all.
Okay, very well. Also wanted to share that we had the office had our annual summer picnic last Friday. It was at the Kelly Park. It was very well attended. The summer committee did a fantastic job. I think staff really enjoyed the time, and so we want to thank the board for allowing us to have that summer picnic in the afternoon on last Friday, and it's something that we look forward to every year. And we take also the time to congratulate and to we select a couple of members from the staff, and we thank them for the extraordinary work throughout the year. So we did that as well. We also wanted to share with you that we hold quarterly staff meetings at the office. We done that for 10 years. We actually skipped 2 quarters just early this year, but we went back to it this month, and we had our quarterly staff meeting this week on Wednesday. Again, attended by staff at the office and those working remotely. And we specifically invited the Chief Information Security Officer from the city to attend and provide staff some comments on cybersecurity at the city level. So that was, very, very helpful, and we appreciate the time spent with the staff on that issue. I also wanted to share with you that the office will be closed this coming Monday, June 19th, in observance of Juneteenth Day, and also on July 4th, in observance of Independence Day. And lastly, I wanted to give you a couple of personnel updates. I hope you can join me in welcoming some new staff to the administrative group. First, Edith Aldama. Edith is our new staff specialist. She just joined our office last May 30th and will be working supporting the Police and Fire Board and committee meetings. Also, Cheryl Aledo. Cheryl actually is our new staff specialist, and she joined us in early May. And we actually will be supporting your board on your board meetings and subcommittees. And also we have, if you give me a second, we have Mallory Vidal. Mallory actually worked with us, also supporting the administrative staff, and she actually comes from the temporary work services. So welcome to all of you. Thank you for your time and your work. We need you, and so we appreciate your efforts.
Welcome.
Thank you. Lastly, I also want to share with you a couple of things. The accounting group is actually conducting some interviews for the new web position, Accountant 1-2. So those interviews will probably take place in July. And I also wanted to remind you 2 things. At times, either because of meetings or other issues, we want to get in contact with you. So if you can confirm with our administrative staff what is the best contact information that you have in terms of you either email or a phone number, to make sure that we can actually either text you, call you, or email you. And you all receive an email from Michelle regarding potential subscriptions that we want to help you with to receive on a monthly or quarterly basis. And if you can please take the time to get back to Michelle on whether or not you're interested. If you're interested, let her know what are those that you would like to receive. If you're not interested, please just let her know so she can address that issue and take you off the list, so that we can then move forward on making the requested subscriptions. That concludes my oral update, Mr. Chair. I'm happy to answer any questions.
Thank you very much. Are there any questions from trustees?
I have one question.
Yes.
And it's a small one, but it has to do with regard to the subscriptions. There's certain ones I already have, but I'm wondering if there is a consensus from our group about which ones all of us should subscribe to.
This is a new program, so no consensus exists.
Or
yet.
any people's opinions about which ones. I know that I subscribe to the Wall Street Journal and the Economist already. I'm wondering if there's a gap there.
We should just give you the list that is, clearly it was circulated before you became
I
a
saw
trust.
I saw the list.
Oh, you did?
Yeah.
And the staff's in the process of getting group subscriptions, so we just do it by email with them and add any names that you think are missing.
Yeah, my question was more like, is there a recommendation?
There's no recommendation. We wanted to share with you what the options were. And it's, there are all of you have different kind of backgrounds, so it's really up to whatever it is that you're looking to do.
In addition to those, I think Institutional Investor and CIO Magazine seem to cover pension-related issues and specifically or asset allocation issues. So
I think the Financial Times was also recommended for more global reach.
Right.
Thank you.
And pensions and investments is a good source.
Yeah.
P&I.
I don't think that was on the original list, but perhaps we should look at that. Okay, any other questions? If not, then we will turn to our City Council liaison, Councilmember Davis.
Thank you. We passed the budget on Tuesday after much discussion on Monday and Tuesday. And we are still in negotiations with a couple of bargaining units. So that's kind of the update. Not a whole lot. We're winding down before our July break. Happy to take any specific questions about the budget. I'm not going to summarize the 14 hours of discussion we had about it.
Okay. And indeed, are there any questions from trustees?
So you guys won't be bargaining during July then? It'll pick up again in August?
The staff will continue bargaining, but we won't be able to ratify agreements until our first meeting in August is scheduled for, I believe it's the 8th.
Okay, thank you.
Any other questions?
We did ratify a bunch of agreements already.
My only question would be, were there any things in the budget that could impact the board or that we should be aware of?
The only thing I think, and I think this might have been announced already, is that the city will not be pre-funding this year. That's the only thing that I think directly impacts. And
we did announce, yes.
Yeah, I thought you announced that.
Okay, thank you. Next item, discussion action on committee assignments. So with the departure of one trustee and the addition of 2 new trustees, we can get to full membership on our 5 committees and make that a bit larger if we could. Thank you. So here we have the existing committees, and in red, the new assignments suggested by your chair. Just as a bit of context, there are 5 committees, 3 members each. We try, but don't always succeed, to have a mix of, quote, public members and plan members on each committee. And these are my suggested changes and additions. So each trustee has 2 assignments, with the exception of our vice chair, Julie Jennings, who has 3 assignments, although she had 4. So this is a movement in the right direction for her. And most of these committees are equally active, I would say, with the exception of governance, which is to date relatively light in terms of their activity. So trustee of, sorry?
Could get more active.
Could get more active, but hasn't been. But in any case, I'd like to ask trustee Linder to take the helm over there. And trustee Avasti, I think the audit committee has new and increased focus and importance. I'd like to ask your expertise to chair over there, and the other assignments you can see as they are. So if there's any questions, comments, rebuttals?
I think on the disability committee, it requires all that training. So Matthew will need to go through the recordings that we have.
Correct.
Get himself up to speed.
Right. Yeah, we'll make sure he's still have yet to be sworn in, but yes, we'll make sure that we provide those links to him. We're also going to be scheduling onboarding meetings with Trustee Abbott and Faulkner, and I will make sure to mention that as well to him during our meeting.
And maybe you can also, I would offer him, time with, the legal counsel who's been helping us through that educational process.
Yes, both trustees also are they usually have an onboarding with legal, not as exciting as the one with staff, but we do allow you to spend time with legal on fiduciary responsibilities and everything else. So yes, we will make sure to do that. Thank you, Trustee Jennings.
My rationale for asking Trustee Faulkner to work there, as you recall from his interview process, he already has some experience in quasi-judicial proceedings as an adjudicator for the
FINRA.
FINRA, thank you.
Self-regulating.
So I'm hoping he has some
SROs.
marginal experience that will aid in that process.
So one question.
I'd just like to say that I would like to be on the investment committee.
The investment committee is always the most oversubscribed and most demanded, so it's always a challenge to parcel out those assignments, but we revisit this in January of every year after a new chair and vice chair are elected in December. So these assignments are at least for the remainder of this year only, this calendar year.
So there's no opportunity for me to move to that, to switch with Matthew?
There is if we were to vote on it and to approve that, but this is my current proposal as chair.
I also want to, go ahead.
I also asked to be on
Okay, yeah. So we
3 years.
I'm sorry, Julie, we couldn't hear you. What did you say?
I said I also requested to be in the investment committee and have been a trustee for 3 years. However, my plate is full, so I would have had to leave another one. But I also want to provide Chair Horowitz his best, the people that I'm standing behind his choice.
Thank you, Vice Chair Jennings. As a
You're
member,
welcome.
as a member of my administration, I
Even
appreciate
though I
your
was
support.
disappointed. Okay.
As chair, certainly in this realm is a exercise in disappointment. So
Yeah.
that is something I must face up to.
I just also wanted to share this for the benefit of Trustee Abba, who's a new trustee to the board, that you notice that committees are formed or comprised of 3 members, and that's a requirement because your board is comprised of 7, so we cannot have a committee comprised of 4 members because that will constitute a meeting of the actual board if a quorum actually meets. So that's another reason why the committees are comprised of just 3 members. Otherwise, we could be adding more names at different times.
And let me add to that additionally, that these are all public meetings. Anyone can attend, any member of the public, anyone can comment. And while the IC occasionally votes and takes action, they are at best recommendations of actions to the full board, where the ultimate authority lies for any action that we must take. So we certainly welcome your participation and insight at the IC.
If I can
And
add,
it's also recorded.
if I can add to what the chair just said, IC meetings are a lot more boring now than they used to be after delegation of authority to staff, and we only meet 4 times a year. So it's not as exciting as it sounds.
I think
Okay.
that's a slide on my chairmanship.
Thanks to a wonderful chair.
No, I think that's a kudo to the chair.
You guys were just slammed by Roberto, and I think I just took a hit by the CIO.
But perhaps we should auction
For-
those seats as a way of increasing plan
For-
assets.
For what it's worth, since I've been on the board, I think in the longest tenure, there's been more interest in being in certain committees as opposed to sort of serving where the need is. So for what that's worth, and I think you're doing a good job of trying to accommodate everyone's requests.
Okay, and these will move around and change over time. So the assignments do evolve year by year.
I have a question.
Yes.
It's a question for Roberto. I don't recall the rationale for having an alternate in the disability committee before, but I'm wondering if you need it now, or because I know I was appointed as an alternate.
I think the reason at the time we added an alternate was, if you remember, we were having remote meetings and we were sort of thinking about coming back to the to having this meetings in person, and we wanted to make sure that we didn't have to cancel a meeting if we didn't have a quorum. So having 4 with an alternate made it easier to make sure that we had a quorum for the meetings.
Okay, makes sense. Thanks.
Okay, any further discussion or questions? So do we have a motion then to, do we need a motion, or can this be done by we do need a motion?
Yes.
I motion to accept the list.
Okay, we have a motion to accept by Vice Chair Jennings. Do we have a second?
I second.
We have a second from Trustee Avasti. Any further discussion? Any public comment? Hearing none, we will vote. Vice Chair Jennings?
Aye.
Trustee Chandra?
Aye.
Trustee Avasti?
Aye.
Trustee Abbott?
Aye.
Trustee Linder?
Aye.
And I vote aye as well. The motion passes. Thank you.
Thank you, Mr. Chair.
Sure.
It's not an easy task.
It's the chair wears many difficult hats,
Heavy as the crown?
for which there is no extra compensation, I should add.
No, there is not.
Item 5D, discussion and action on incentive compensation ranges. Who is, Trustee Chandra, as Vice Chair of the JPC, you're going to present on this?
I suppose I should.
I think so.
But I admit to not being fully prepared to do so.
Go for it.
Please feel free to help out.
Okay.
But I will lead the conversation, Chair Horowitz. After several months of discussion at the JPC, the police and fire representatives and the Federated board representatives have been implementing a incentive compensation program. The goal of the incentive compensation program is retention, and also to attract staff in the future that is of the caliber and performance that we've achieved over the past 3 to 5 years. It is the belief of the committee that alpha can be generated by things like manager selection, and good teamwork and leadership has been demonstrated by the CIO in training and mentoring and helping his staff improve their investment acumen. I will editorialize and say that it's been a long 5 years in moving in this direction, and most of it has been, in my opinion, structural, whether it's governance or investment policy decisions like one of the ones we just took earlier today. But ultimately, it is people. You can only do so much institutionally to put any system or any plan in place for the long term, and we want to make sure that we have the right type of staff to help us continue to improve our funded status and do the good work that's taken place thus far. So with that, there was a lot of back and forth as to what the right incentive amounts were. I won't go through that sausage making. We ultimately concluded the police and fire brought it forward to their board earlier this month, and I believe it was approved. And so we're seeking a similar approval for details to be still fleshed out in the criteria and how we arrive at the metrics by which incentive compensation is given, but a maximum range of 50% of base salary for the chief investment officer, a maximum of 40% of base salary for senior investment officers, people holding that title, and a maximum of 30% of base salary for the investment officer position. Anything I missed, Chair Horowitz?
I think only to say that this is our proposal for something that must be approved by City Council.
Thank you. That's very important.
So that's the rationale. Just to reiterate, the one small point is the algorithm by which the bonus will be applied is still under discussion. But first, we wanted to figure out what is the top dollar amount that could be achieved. That is, if everything goes right and they hit all the metrics that are in the algorithm. So again, that's the 50, the 40, and the 30%.
I have 2 questions.
I can say one more thing to that.
Okay.
We looked at, comparables, who was doing, this type of incentive program.
Thank you.
And that was Orange County and San Bernardino. And Orange County was higher, I think I have this right, and San Bernardino was, I think, at the 50%. We chose to go 50%. We chose not to go to the highest. We know there's sensitivity from the city and to incentive programs overall. And as much as we want to be leading this effort, we chose a more conservative approach so that we can move this one forward and get our sponsor to also support this. And this is supporting Alpha. So that's the major reason for it. And to provide compensation when that is done over a period of time, not just 1 year. So there's a lot of components to it. There was a lot of discussion. Of course, we wanted to go higher. We wanted to do Orange County, but we're trying to be cognizant of the city and how, and what city council would hopefully support.
Thank you, Vice Chair. Trustee Abbott, question?
Yeah, so I'm wondering, there sounds like there's a couple of benchmark cities that you guys looked at. I'm wondering if this is something that has been an issue in terms of recruiting people to fulfill this kind of position, the fact that there hasn't been incentive pay. So that's one question. And then the second question would be, let me think what that was. What is that sort of, where do the funds come to pay this? Does it come out of the city budget, or does it come out of the returns that we have from the investments we make?
Well,
and does it have a significant impact on the returns?
I'll answer the second question. Is it comes out of the ORS budget, and the numbers in terms of dollars are insignificant compared to the size of the investment plan. But as to the first, I don't know if you'd want to address its relevance to recruitment in the past or future.
So what I would say is that the committee is concerned that the market for our current talent in the private sector and in foundations and endowments is significantly higher. We have no intention of ever matching that. We're aware that we're a government pension plan, but we're trying to do what we can with some of the attendant other benefits that come from working for the city, pension, et cetera. Also, I think people derive a lot of personal satisfaction in doing public service, but that nonetheless, we were still out of whack. And now I'll editorialize. I've used this metaphor too many times. I'm tired of hearing myself say it, but I have noticed in the pension world that there's a Goldilocks principle. You get young people willing to take a much lower salary because they get to play with billions of dollars of assets, and then they move on to a private sector job and you lose the continuity. Or you get people who are very experienced in their career and have made a bunch of money in the private sector, and I mean, really editorializing, don't want to play golf 5 days a week. They still like to show up at conferences, sit on panels, and be important. Finding that warm porridge, someone who can, is comfortable with a government salary, but we'd like to create some incentive to make it a little more interesting so we can get really talented folks who are at the prime and see this as a place to leave their mark.
And you stay here.
Leave their mark for 10, 15 years.
Yeah, this is targeted both at retention of existing staff and or recruitment of new staff if we are unsuccessful in our retention efforts. And I think we've identified 5 other existing pension plans in the state that offer some type of incentive bonus, and that number may be increasing. And of those, most are in coastal counties or coastal cities where the cost of living is much higher. I don't have to tell anybody that. So, if you're serving Bakersfield, it may be easier to recruit there. But if you're serving,
But if you get tired of teaching.
yeah, that's right. Well, there are rules apply to that though. So,
well, and also, I don't know, Roberto, maybe you can help on this one. the bonuses would not come out of the ORS budget, right? Because I thought the investment staff is through the investment returns. They're paid through that. I didn't think they were part of the ORS personal services budget.
I don't want to put words in the chair's mouth, but I think what he meant was that it's coming out of the plans. So it is coming out of the earnings of the plans.
There,
yes.
But there's a difference when you're talking city budget.
Yeah, I mean, to be honest, that's a very good question. That no need to decide, at this time. But at some point, we need to decide whether we're gonna record that as a deduction of the earnings, or we, gonna, because it's gonna be paid out. I'm assuming as a payroll, right? It is an earning for the member, for the staff. So it's a long way of telling you. I think right now I will view it as a deduction of the earnings, but I think that have to be decided long term. Thank you.
But perhaps it helps to put specific numbers on it. So 50% of the CIO's salary, that would be the maximum bonus under this incentive scheme, would be exactly what in dollar terms?
I would say about $170,000, right, Prabhu?
Okay.
Yes.
Against, and that's for across both plans, PNF and Fed, is that correct?
That's right.
That's
So
correct.
that's out of a $8 billion portfolio.
Correct.
Okay.
Yes.
Okay. And I'm not in the habit of doing this, but I certainly would invite Council Liaison Davis to comment on this particular item if she would care to do so.
Since we haven't had this discussion at council, I really can't speak for all of council. I think I have had a discussion with Trustee Chandra about this, and I think that it does make sense to try to incentivize performance, and I do think that finding a middle way is good for trying to hire, but finding a middle way that will be palatable to council is also something to take into consideration, right? Because this is not something that we do for our finance staff, and we do have finance staff on the city side as well. So I'd just keep that in mind.
Mm-hmm. Okay, thank you for that input.
I do also wanted to mention, I reach out to the city, and at this point, this item on incentive compensation and the previous item approved by the boards on the changes, proposed changes to the salary ranges. Tentatively, I asked the city to put down some time for August 22nd. I will certainly keep both boards apprised. That will not be decided today. I think once we come back from the long month of July, and we have the agenda review meetings with the city staff, we will let you know whether this item will go to city council on August 22nd, August 15th, or August 29th. If I have to bet, I would say it will be sometime between the 22nd and 29th of August.
Okay, great, yes. I imagine some members, some trustees would want to be at that meeting or comment on that meeting.
Yeah, again, we'll reach out to both boards. I think the recommendation or the request will be that to the extent that you are available, it will be helpful if, I think the goal is to have the both IC chairs to present to council, but having most of the board trustees there as a support and answering any questions by council, I think would be very helpful, yes.
Okay. All right, if there's no further discussion, would anyone like to formulate a motion? Oh, sorry, go ahead.
Are you also planning to bring the algorithm to the board?
I'm going to say something. If I misspeak, please correct me.
Okay.
I think the JPC decided they haven't determined that yet.
Okay.
So the answer to your question is no. I think they will be, the IC chairs will be ready to kind of speak generally about it. But
I think it might be the JPC chairs.
Oh, what did I say?
I see.
I see.
It just happens to be the IC chairs are
Oh,
the
wow, yeah.
chair and vice chair of the
Yeah.
JPC. You are
It
correct.
does-
Okay.
that-
Is that
exactly.
the
Yes.
case with
Yeah,
police and
Esquire
fire
is
too?
the
That is
chair.
the
Okay.
case.
Yeah.
All right.
But no, but they haven't decided yet, and I would expect that to be a few months discussion at the JPC before they're ready to. But I think your question is fair, because I think we need to be ready to at least provide some sort of a basis for understanding. You're correct. So, but it hasn't been decided.
Okay.
Yeah, I think it felt like a lot of information to try to communicate at a council meeting. The algorithms, the definitions, the financial terms, and all that. So we wanted to get buy-in at the the ultimate absolute potential dollar amounts we thought would be the most important thing to communicate and share.
Oh, is that where you are, baby?
You're not on mute, Vice
Oh,
Chair
I'm
Jennings.
sorry.
Okay. But say hello to your cat for us. All right, so.
I have a brand new kitty,
Okay.
so that's, I was searching for her
All
and
right.
seeing where it
She
was.
does not have voting rights.
Does not have voting rights.
So.
Mr. Chair, I'll
yes.
move approval of the recommendation.
Thank you, Trustee Linder. Is there a second to that
I
motion?
second
We have a second from Vice Chair Jennings. Any further discussion from trustees? Any public comment on this issue? If not, we will have a roll call vote. Vice Chair Jennings?
Aye.
Trustee Chandra?
Aye.
Trustee Avasti?
Aye.
Trustee Linder?
Aye.
Trustee Abbott?
Aye.
And I vote aye as well. Motion carries. All right, move on to committee reports, agenda item 6. The much heralded investment committee. Trustee Chandra, would you care to report?
Yeah, there's no update from April, and obviously we're meeting again in August. Most of what the investment committee has been doing has been presented or voted upon in the last two board meetings.
Exactly. And then the governance committee, lastly chaired
No.
by Vice Chair Jennings, and it sounds like there was nothing to report. Okay.
Nothing to report.
The audit committee, our previous chair has departed, and I think we are aware of some of the activities recently encountered by the audit committee. I hope Trustee Avasti is prepared for her new duties as chair.
The new chair.
And they'll have their next meeting at August 17th. Did you, as an attendee at the last meeting, did you have anything else you would want to report?
So the joint audit committee meeting last month, we had a discussion on the audit plan by MGO, which is for action in this meeting.
Mm-hmm.
And then we also discussed the procurement and contracts internal audit. But I would not be giving an update now. We still have to finish the discussion.
Okay.
So once we get that opportunity, we'll bring that to the board.
Okay. It does look like under item 6.3D, we do have discussion and action on to approve the MG&O audit plan. Is there?
Correct, Mr. Chair. The committee did receive that presentation and approved it, and is recommending it to you, board, for approval. This is the action plan for the upcoming external financial auditor for June 30th, 2023.
Okay. Is there any questions or comments about the audit plan?
I'll make a motion to approve the audit plan.
Okay, so we have a motion from Trustee Chandra. Do we have a second?
I'll second.
We have a second from Trustee Linder. Any further discussion by trustees? Any public comment? We will vote. Vice Chair Jennings?
Aye.
Trustee Chandra?
Aye.
Trustee Avasti?
Aye.
Trustee Linder?
Aye.
Trustee Abbott?
Aye.
And I vote aye, passes. Disability Committee. The last meeting
No
was,
meeting until August.
no meeting till August. When are we expected to actually hear our first disability case at the Disability Committee?
We're hoping it will be August.
At the next meeting in August, okay.
Yes, he's assured me we have a large backlog.
I've been told that several times, so it's going to be an active committee.
Yes.
All right,
But August will be the first one.
okay. Joint Personnel Committee. I think we've heard the bulk of what has been under intensive discussion. I don't know if trustee Chandra has anything to add to that at this point?
No, that's it.
Okay. Then moving on to education and training, we have the various opportunities for education. If there's any questions about that, or any proposed agenda items from trustees or members of the public? Hearing none, this meeting is adjourned.
Very good, sir.
Thank you.